Hi, welcome to the Financial Dispensary with me, Dr. G. In this week's episode, we're going to show you what to do with the surplus money that you've freed up in your budget. You do not want to miss this episode, so stick around. So welcome on this series of episodes that we're currently launching to lay the foundation in how to assist you growing towards financial independence. So just to recap again, the first step, do the budget. The second step, rearrange the budget so that we get to that magical point where you spend less money than what you earn. That's the only goal that you want to try and achieve. More money coming in than going out. In this week's episode, we're going to say, okay, what are we going to then do with that surplus money? And it's straightforward. Step one is you need to identify what your investment goals are. So to give you a practical example, I'm just going to pivot to our robo-advice solution, which is called Wealth Pro. And here you can see with regards to the goals, there's various investment goals that you can work towards. So what we've seen over the last, let's call it decade or so, it's very important that you allocate a specific goal to each of your investments. The reason why this is important, it makes that psychological link between why you are making the saving and the sacrifice. Because remember, when you do investment, you're effectively sacrificing the now for a bigger, greater benefit later on. And by linking that to a specific goal, you are, from a behavioral finance point of view, more inclined to stick to the investment. So you can have a range of different investment goals. In Wealth Pro, we just identify 8, the big ones, obviously retirement being probably the biggest investment goal for a lot of clients, education, buying a home, safety net, the tax-free saving, travel the world, grow wealth and save more. So there you can see these are kind of the big kind of investment goal buckets that you can allocate into each one. So the first step in terms of this journey is identifying which investment goal is the most important for you. As an example, I'm just going to delve into one. I'm going to choose, let's say, travel the world as an example. In Wealth Pro, we've got a bit of a decision tree or funnel, so you can complete a couple of steps. So you can see in this one, do you wish to start off with lump sum? No, I don't have a lump sum yet. When do you plan to travel? Let's say I want to plan to travel in about 4 years. Do you want to contribute monthly? Yes. Based on the goals and tips that I gave you last week, I was able to save, let's say, 2,000 Rand per month. And am I able to increase my monthly contribution annually? Yes, but let's say only with 5% as an example. Based on this, then Wealth Pro, we have some algorithms in the background. We'll do a basic calculation for you. And you can see based on that, if I were to save this 2,000 Rand per month for 4 years, escalating it by 5% per year, I should have roughly 126,306 Rand in that 4 years. And we just, as an example, give you an indication that it's probably roughly equivalent to a ski holiday. Within Wealth Pro, you can also toggle around and play around and see the effect of, as an example, saving for a longer period. You can then save your goal, you can give it a specific name. So again, from behavioral finance point of view, why this is important, by just adding a picture. Let's say I would want to go on a ski holiday as an example. By adding a picture of me in a ski slope or a mountain full of snow, the likelihood of me committing to that investment on an ongoing basis is much higher. So that would be the first step with regards to starting your kind of investment journey, is to decide what are your investment goals. Second step would be, well, what is your risk profile? Again, this is something very personal in nature, but this is where you need to identify in terms of what your appetite towards risk is and what type of investment vehicles will suit you the best. So let's give you again another practical example how this would work. So again, pivoting back to this screen, to Wealth Pro, I'm going to just jump to the risk profile section quickly within Wealth Pro to give you that example. I actually want to go out here. just go to my profile section here. So in the profile section, you'll see there's a little second from the bottom, there's a section, what is your risk profile? And I'm just going to redo quickly my risk profile within WealthPro to give you an indication in terms of the questions that we as financial planners would ask a client. So the first question, fairly straightforward, what is your current age? I just turned 41, so I'm in this bracket. The reason why the age is appropriate is that the longer your potential investment horizon, the same question, remember, that we asked is, when do you want to go on this ski holiday? Your investment horizon is a very important variable that we take into consideration when we build the investment. And similar to your age, the longer your potential investment horizon, the better. So the younger you are, in theory, the more risk you can take, and the older, traditionally, the less risk. Next one is, in the future, I expect my income to do what? Does it decrease, increase dramatically, or be unstable? Again, because I'm very optimistic in terms of the business ventures and my knowledge base that I'm expanding, let's say I'm very optimistic and I'm saying that my income will increase dramatically year over year. When I invest, I want to. So you just want to protect your losses and protect your initial investment and avoid loss at all costs? Or would you prioritize investment, long-term growth, even though in the short term you might see drawdowns or kind of a reduction in your investment? So again, very personal. Most clients tell me that they want maximum returns, but they get very nervous or anxious when they see the investment reducing in value. So again, you can decide in terms of where you are on the scale. Let's say we decide to see a gradual increase in my investment over time. Next one is, how much money do you have in your saving? So as an example, let's say if you just start out now, you have got nothing, but if you have a lot of savings already saved up, that will also have an impact. And again, the thinking behind this is, if you don't have any savings, you are a bit more risk averse, but if you have a lot of savings or you have a lot of time on your side, you can take on a lot more risk. Fifth question is, how much do you know about investment? So this is also very important, and this is the idea with regards to the financial dispensary. Remember, I'm trying to educate and help you to expand on your financial knowledge. So the more you know, more knowledgeable you are about investments and funds and portfolios, the more risk you can take. And the less you know, the better idea it is to start small, start with your training wheels on, and then build and grow into your knowledge. Last question, your investment dropped by 20% this month. What do you do? This is a very interesting question, because again, if you say you would get anxious and withdraw your money, it means by default you're slightly more risk averse. But if you said you're prepared to invest more as it's cheaper now, that obviously tells us a lot in terms of your psychology. And it's always very interesting for me is that when a client sees a 20% reduction in the investment, they get heart palpitations and they get flustered and very anxious. But if you walk into Woolies and you see a 20% discount or sale, you get very excited. However, it's exactly the same thing. Woolies are selling a product at a reduced value, 20% less. It's a massive savings, yet you get excited. But if you see on your investments a 20% loss in your investment, you get nervous. Obviously, there's various other factors to take into consideration, but remember, a reduction in the value of your investments doesn't necessarily mean it's bad, as long as it's not a permanent loss of capital. And based on that, how you answer the questions, it's fairly straightforward. You would then be on this kind of what we call the risk profile or spectrum. And the spectrum is usually from very low all the way to very high. You can see my result here is high, which is kind of just below very high. And the description that we allocate towards that is, you are a high risk investor who is not put off by high risks. You're quite happy to shoot for long-term maximum returns, even if it means riskier investments. And that kind of summarizes me quite well. I feel that I'm knowledgeable enough. I've got sufficient time on my side to take slightly more higher risks, but I want to be remunerated for it. So the returns need to come through with regards to that. So that would be the second step in terms of identifying kind of which investments would work well for you. So third step. So once we know the kind of investment goals that you have, and once we have a good grasp in terms of what your risk profile is, the third step is to get a better understanding of what is the ideal asset allocation for you. So Just going to quickly showcase you in terms of how we deal with regards to this. So asset allocation is a term that you'll hear quite a lot. So let me just jump to this section quickly and show you this. Asset allocation, or asset classes at least, and the asset allocation means what is the mix of the underlying investment instruments that's wrapped into this one investment. So I'll give you a quick example in terms of the various asset classes. Those are the big categories. So I'm starting on the left hand side and I'll work my way through to the right. Obviously you are all familiar with cash, money in the bank. You'll see in the top it gives us a couple of indications. So that's your bank account, your savings account, fixed deposit. And what cash represents is liquidity and the power to buy anything. So remember, cash, you earn a fixed interest traditionally. You can immediately use it for something. So the liquidity there of cash is quite handy. The next one, the green block, is equity. So equity represents ownership in a business. So that's when you earn a share, or in America they call it a stock. So you'll have index funds, mutual funds. In South Africa we call it unit trust kind of investments. So all of those, I'll give you a practical example just after this in terms of what equity kind of represents. The next block is what we call kind of fixed income. And fixed income, also sometimes referred to as bonds in South African context. It represents when you lend money to somebody, traditionally to a government or to big corporate. You'll see in South Africa on your fund fact sheets, you'll see the term bonds or fixed income is a representation of this. The next one, the orange one, is real estate. We all know property quite well. It's the ownership of a physical space, and property is usually divided into various sectors. So we're all very aware of residential property. But you also have office space, industrial, which is like a warehouse, and office space, residential, and retail, kind of the shops, as an example. The yellow one, not that common in South Africa, but commodities, represents ownership of goods, which has an end value. So we refer to it as hard commodities and soft commodities. Hard commodities are all the metals, gold, silver, platinum, and soft commodities, all this are all traditionally elements that you would eat. So corn, wheat, sugar, maize fall into commodities. And you'll see on the right hand side, as I mentioned earlier on, I'm very pro in terms of the crypto and how digital assets will change our world going forward. I added crypto, which I feel will be an asset class in the future, and that obviously represents a digital ownership of a service. And examples there are blockchain technology, kind of the protocols built on top of these blockchains, NFTs or non-fungible tokens, and DAOs, decentralized autonomous organizations. And in future episodes, I'll delve into the various subsectors of all of these asset classes as well. The reason why I gave you a high level in terms of the asset classes is that each asset class is a representation also in terms of the risk profile. So the risk profile, as you can see, it works from bottom left to top right. So you're on the X axis, the bottom one, you have your risk profile, and the Y axis is on the vertical axis is your expected return. So the more risk you're willing to take, the higher return profile you should get. So starting bottom left, cash will give us a low return, but also a very low risk. Then the next two, bonds and that high yield and hybrid securities or fixed income, will give us a slightly higher return, but you need to understand that it comes at a slightly higher risk level. The next one would be property. The next one, the developed market stocks or shares and emerging market stocks. So remember, South Africa is the emerging market. Those will be higher. And then crypto obviously will be top right, very, very risky, but the highest potential return profile. So as you can see, by mixing and combining all of the building blocks, we can get to a situation or to a stage where we can get the ideal investment portfolio for you that works well. So as an example, again, just giving the practical example, remember my goal was to save for 4 years to go on a ski holiday. So based on that example, it's unlikely that I would just choose cash. The reason just for cash is 4 years is sufficient time for me to allocate money towards a specific investment, and cash will just be, the return would just be too low. It's also unlikely that I would go commodities and crypto as an example. 4 years traditionally is like a balanced, kind of a mixed kind of portfolio. So I'll have some equity exposure, some property, but predominantly fixed income and cash. Will actually be a nice split between all of those 4 asset classes. And again, if all of this is a bit more too complicated or getting too complex, that's the goal of your financial planner, and that's the value that your financial planner can play by assisting and helping you getting that ideal mix with regards to what your investment portfolio should look like. So to summarize, and I'll give you one practical example as we end off now, is step 1 would be, what is your investment goal? Second step is getting on the idea of what your risk profile is. And then third, combine everything together. So we're going to combine your investment goal, your risk profile, the asset allocation, so that we can get to the ideal investment portfolio for you that works well. To give you a final example in terms of how this works well is the following. I'm just going to jump to this little section quickly. So what I did in terms of, I jumped online and I had a quick look in terms of a portfolio manager that a lot of you will be well aware of, Coronation. And I looked at the fund fact sheet to give you a practical example in terms of how practically this would work. So here we can see this is the Coronation Strategic Income Fund, and this document is what we call a fund fact sheet. You can see this important portfolio characteristics and the risks on the left hand side. You can see this portfolio's risk profile is rated 2 out of 10, and because it's 2 out of 10, it's rated as conservative. And you can see the allocation towards growth assets and income assets, only 25% allocation towards growth assets, which is property, equity, in the future crypto, and a bigger chunk, the vast majority, towards income assets. And by looking at that graph, you can see that blue line, the dark blue line, that kind of return profile of this fund. You can see it's nice, smoothed out, and this is exactly what you'd like to see from a conservative kind of portfolio. Looking at the return percentage, you can see since inception, this fund has a return 9.5%, which is really fantastic for a fairly conservative fund. So if we now compare this data with another Coronation fund, the top 20 fund, if we go down to the important profile section and look at the risk profile, you can see now this fund's risk profile is rated 8 out of 10, which they deem aggressive. And you can see now the income versus growth assets, 100% allocation towards growth assets, so equity, property, and again in the future potentially crypto, and 0 allocation towards the income assets, which is cash and bonds. So again, if you look at now the return profile, you can look at the dark blue line. You can see there are those drawdown periods. You can see there was a period here, early 2000s. The closest example that we have is obviously during COVID as well. So that's where you'll see a potential drawdown. But remember, over the longer term, you will be remunerated for that. And you can check that again, since launch, annualized, this return, the top 20 fund has done 16.5%, which is absolutely fantastic. And there you have it. Those are kind of the building blocks that you can follow for yourself in terms of building out your investment portfolio. So again, just to recap high level, step 1, do the budget. Step 2, rearrange your budget so that you have surplus money available. Once you have that money available, we need to start filtering that money into investments. Which investments? Well, as I said, look at WealthPro as a good example. I'll drop the description for you in the description. Do your identify your investment goals, do your risk profile, and get that mix in terms of the asset allocation right. The more conservative, the less drawdown you'll have, but the lower the returns. And on the other side of the spectrum, the higher the risk profile, the higher the return profile. All of those steps I've identified for you are built into WealthPro as well. So if you're unsure, you can just play around within WealthPro. As I said, as a final example, you can always just, if you're unsure about anything, you can just drop a question in the comment section and we endeavor to answer that for you. And there you have it. We're done with step 3. We're working towards building your financial independence, and you're one step closer to achieving that goal. Thank you for watching, and until next week's episode, bye-bye.